Welcome to Growing Empires. I'm your host, Jennifer DeJesus, and today is our Investor Intel segment. I recently sat down with a colleague of mine to talk about our real estate journeys and how they started out very similar and how they landed in very different avenues. We talked about the real estate market over the last decade or so. We talked about our wins and our losses and what we're taking into the future in both of our real estate investing journeys. So I'm really excited to share how that conversation unfolded. So let's get into it. Welcome to Growing Empires. I'm Jennifer DeJesus, real estate investor and operator. This show takes you behind the scenes of how real estate assets are executed, managed, and positioned for long-term performance. Let's get into it. So as I mentioned, I had sat down with a colleague of mine in the industry just a day or so ago for coffee. And the purpose of the meeting was nothing really formal. It was just to talk about what's happened over the last couple of years, where our real estate journeys have taken us, and what we're doing for our personal investments and what we see as the outlook for the future for both of our careers. I should mention that this colleague of mine had a very similar start to his real estate interests. He was as well in corporate America as I was. And although he was not downsized, he was definitely living a life that he was not excited about. He was in the accounting field. After his college education, he went into the accounting field and was working in corporate America and just hustling hard. And he saw himself losing time with his family. He saw himself working crazy hours, working for somebody else's dream. And like me, decided to make a change to that. And although my change was far more abrupt than his was, he also made an abrupt change. And it was his change when he decided that he was no longer going to work for the man. He was no longer going to work for somebody else, and he was going to use real estate as his vehicle to build his financial freedom and his financial wealth. I start this conversation by saying that so many of you may be in similar situations. You may be finding your corporate job, maybe your job in the medical field is no longer fitting your future self. It's no longer fitting or supporting your family and the time that you want to spend with them, doing the things that you love to do. And for so many people, it's like a noose around your neck. It's the inability to think about how to go a different path. It's the inability to see that there's a financial outcome that can be positive, that doesn't require you slaving over hours day in and day out in whatever field that you're in. While myself and my colleague took a little bit more of an abrupt path to our journey into real estate, you don't have to. You do not have to make an abrupt jump and leave your cushy corporate job to take risk if that's not your risk profile. And what I mean by that is so many people are successful at finding the right partners and investing in real estate in a passive manner until real estate can become their full-time direction, or until real estate achieves a passive income level that supersedes your corporate income. What I want you to take from this story is a couple of things. One, there is no right time to do it. It doesn't matter what market we're in. There is no such thing as a bad market or a terrible market. Your investment has to change given the market circumstances, but there is no bad investment. If you wait for the perfect deal or the perfect time or the perfect opportunity, you will miss it because they never show themselves as such. Take it from two people who learned in very different ways how to make real estate our vehicle for passive wealth, financial freedom, and know that you too can do it. And it doesn't always require your time either. It requires your trust, a partner, and somebody to help you execute on a plan, but it doesn't necessarily require your time if that's what you so choose. As we sat down and we had a conversation, we talked about the last decade or so And it was pretty specific that we were in the Lehigh Valley market and we were talking about the Lehigh Valley over the last 10 years, how we both jumped into real estate as a career to start with, and how that then yielded us the opportunity to start investing in real estate on our own. And we talked about the different types of properties that we both jumped into. I went into distressed properties. I went into commercial properties, industrial flex buildings, personally, multifamily properties. I did quite an array of properties, different types of properties. He went into specifically multifamily and then got into short-term rentals. Two different paths with two different outcomes, but both yielding us quite a portfolio of passive investments. I went into the commercial side because I was operating businesses and it only made sense for me to own the real estate that I was operating out of. And I have a particular passion with industrial flex space because of the demand and how hot it is as an asset class in our local area. I also was operating a warehouse and different things like that for the construction business. So industrial flex space was important to me. But I bought a very large portfolio of single family homes. And then I bought multifamilies. And then I bought distressed assets. We had quite a different plan for our real estate investments, but they both went through the test of time in the real estate market. If you think about the last 10 plus years in the Lehigh Valley, as I'm sure you could relate to in your own specific market, there were highs and lows. There was a time where you can buy things at $50,000 a door or cheaper. You can buy very distressed assets. You could buy short sales, foreclosures. Things were in abundance in the market. Those deals were around every corner. And then you saw the market be impacted by economical change and COVID and different things like that. And then you saw so many people lose in the market or get out of the market because they didn't know how to adjust. They didn't have the right partnerships. They didn't have the right financing or structure, debt structures, didn't know how to get out of those things, but also because they either bought wrong or operated wrong as well. But we saw fluctuations. We saw highs and lows, and we saw demand increase like crazy. We saw that be a barrier for investors that wanted to enter the market within the last few years. We saw rent control in New York City have an impact on our ability to find good deals here as money was flooding into our marketplace. You saw the prices of property skyrocket. You saw interest rates hike. You saw inflation. You saw a lot of different things. But in all of those cycles, I can tell you, or all of those ups and downs, there was always good opportunities. There were always deals to be found. You just needed to know how to adjust your structure, and you needed to know how to look at that deal just a little bit different. So our conversation evolved more about how to source the deal and how it needs to change in different market structures, and then what we see for the future of real estate investing. And COVID taught us a lot. Inflation taught us a lot. The rise of interest rates, the cap rate compressions, the recession, all of these things were market dynamics and changes that impacted your investments. Some people succeeded and some people failed miserably. And it was really just about the deal itself and also how you were operating that deal at a time. Our conversation turned a lot more about strategy and things that need to change, or the levers that you need to pull when these dynamics are starting to happen. When we talk about something like inflation and interest rates rising, that doesn't necessarily mean that every investor needs to pull back and wait it out. Because while everybody in the market is pulling back and waiting out, you have lost competition. So if you want to truly find the right types of deals, sometimes you have to not only be looking at a different type of asset or a different area, but you have to be doing it when nobody else is. When everybody was in the market and money from New York, New Jersey, and other surrounding states were flooding the Pennsylvania market, everybody was bidding up the same projects or bidding up the same assets, and the prices of the properties were skyrocketing. And what were investors doing? They were overpaying. They were overpaying because they were doing what everybody else was doing, and then they were bidding against themselves and creating this bidding war. That is probably the dumbest thing any investor could ever do, is get into a bidding war on a property where you're just artificially inflating the value of the property. And I say that because there's never a deal that you want to have so bad that you don't make logical decisions. You don't want to be doing what everybody else is doing if you want the best deal. Now, that doesn't mean that no investor bought a deal where they were in a multiple bid situation and it wasn't a great deal. I'm not saying that. Real estate is never a one-size-fits-all strategy. So there are situations where there were bids on a property and it made sense to be part of that bidding pool, and those assets were going to be the right types of assets for that investor. I'm certainly not saying that that's never the case. You really need to take a look at the market fluctuations and how that changes your investment structure or your investment thesis for that given time. What I mean by that is very simply, how do you adjust during these highs and lows of the market? Well, as we're talking about the onset of inflation and rising interest rates, what needs to change to find the right deal? As the values of the properties increase, so does the rental market. They almost follow the same pattern. So if the price of properties is increasing, so is the price of rentals in the area. Where investors get into trouble is that they take a snapshot in time and they think that that snapshot in time is going to be the consistent baseline for a property from start to finish. And that is never the truth. In a market that you see inflating, what you want to understand is that there is a ceiling, and the only place to go from that ceiling is back down. If you underwrote that deal with a lower LTV, so if in the past, prior to inflation and interest rates going high, you were getting deals at an 80 LTV, 90 LTV, something in that area, you still were making good financial decisions. If you got to high interest rates and you were still doing 80 LTVs and putting no cash into the deal, you're eroding your cash flow at the same time, which is not a smart place to be. While in a low market, you can have high debt, in a rising interest rate environment or a rising inflation market, you should be reducing the amount of your debt, because the more cash you put into the deal, the more cash flow you can yield. The cost of the debt is extreme. The higher the debt, usually the lower the cash flow. What I mean by that is, in no circumstances, you shouldn't be buying. The right deal in any market is still the right deal as long as you underwrote it correctly. So how the dynamics changed, and really where our conversation went, is back in the day when we were getting 80 LTV on and we were getting good debt at really low interest rates, we were underwriting deals and looking at the opportunities that presented themselves at that moment. Those deals look different today because you need to look at how you need to decrease the amount of debt that you're putting on a property to give you the same returns. You need to assume that your property is not going to continue to appreciate in rent value. You need to assume that it's going to come down because you can only get to a ceiling. There's market and then there's everything that's below market, but there's not a place above market that is affordable. If you continue to increase the rent in your property and you increase it beyond what the affordability factor is in that market, you now have vacancies. Vacancies with debt is a disaster. How do we restructure? In rising interest rate environments, we are decreasing the amount of our debt. In lower interest rate environments, we are increasing the amount of our debt. And we're also looking at deals a little bit more creatively. We are looking at partnerships to bring in more cash into the deals. We're looking at more joint ventures or syndicating larger deals. We are looking at doing more distressed assets versus what we were doing previously. We're looking at different asset classes. Like, he jumped into short-term rentals and he's been knocking it out of the park ever since. Now, that's not an asset class that I necessarily get into, but it's been working in this type of environment for the particular area that he's in. And what was interesting about that model is that he used the market shifts to adjust his asset class investment, and he was seeing good returns. I adjusted my capital stack or my debt, and that allowed me to see significant returns. It's just a matter of how you look at it. But the one thing that was consistent in both of our models is that we never stopped investing. We maybe bought less, but we bought smarter. What we were able to do is build a portfolio that is yielding good, strong cash flow, and we're looking at the next opportunity. Those next opportunities could be larger, they could be smaller, they could be in different asset classes. But being able to adjust for the highs and lows of the market and realizing that there's always a good opportunity out there, it just may look like the deal may look different, the capital stack may look different, the underwriting is going to look different, but as long as you make the appropriate adjustments, you still can have a win in any market. Most importantly is making sure that you're not over projecting what something truly can be. And that goes for any market. That's not just the height of the market when rates are sky high. That's literally any market. You never want to buy on pro forma. You don't want to buy on what the property can be because that is your upside. You want to buy on what the property is today. One of the reasons that I'm not necessarily the biggest advocate of A-class properties is similar to the height of the market. I believe that in some respects, everything goes down once it hits a ceiling. I prefer to buy assets that have a value add component, whether it's revenue increasing, condition improving, CapEx going into the building, or some other dynamic. I tend to be attracted to more of the distressed assets. He found a very similar concept that has been working for him, more of the distressed assets, but he has leaned a little bit more into the better condition properties as he's gone into those short-term rental opportunities. So the moral of the story essentially is this: you can find the right investment properties and you can have good, solid deals in pretty much any market. But if your underwriting, if your financing or your debt stack stays the same, you are going to find a losing deal, because not every deal and not every debt structure makes sense for every market. And when you're underwriting deals, make sure that you are not buying on what the property can be, you're buying on what the property currently is. What is the current revenue? What is the current cash flow? And then you're also looking at historicals. You're looking at both the highs and the lows of the markets, not just considering where you are today. If where you are today is a rising environment where the prices of properties is going up and the rent prices are going up, and your underwriting only shows that the value of that is increasing over time, and you never took into consideration how long you're going to hold it and that there's going to be a fluctuation, there's going to be a moment where your projections are wrong. Any good underwriter knows that you need to average out the highs and lows, your balance scale. You need to be somewhere in the middle as far as your projections. You never want to project it all the way to the ceiling, and you never want to project it all the way to the basement. You want to really keep that where the average is over a period of time. And in that period of time, it could be 10 years. If you're really looking at the highs and lows of a market, it could be 10 years or more. It could also be less, but look at where the averages were and use those averages in your underwriting for your upside, not the peaks and the valleys of any specific market. And with some of these tricks built into your underwriting and learning some of the dynamics of the highs and the lows markets, you too can find a great investment in pretty much any market. I hope you enjoyed today's episode, and until next time, take care. That's it for now. If passive income from real estate investments plays a role in your long-term investment strategy, this show is for you. Thanks for listening, and for more in-depth resources, please head over to growingempires.com.